So fractional disparity, basically here we are learning on how these pairs work. It shows a relationship between these pairs, and we know that we're not trading the currencies as currencies, we're trading the currency pair. So a cross of two currencies. So when maybe Euro JPY is moving up, I say that the Euro is strong or JPY is weak. So it's one compared to the other. So suppose the Euro is strong, then you find other cross pairs with the Euro showing the same thing. So when you know how these pairs work, the relationship between these pairs, the correlation, then you can identify a potential move and trade along with it. So we have these triangles here, and in each triangle we have a common currency. So these pairs that are in each triangle have a common currency. Like here we have the dollar, we have the years, the Swiss franc, the Audi, and the CAD. So when we learn on the basics of Forex, we see that we have the majors, the crosses, and the exotics. The majors are made up of the dollar and a currency of a developed nation, a nation with developed economy. And the crosses are made up when two majors are crossed. So here we have, for example, when pound USD is crossed with NZD USD, you get pound New Zealand. The same for EJ, when Euro USD is crossed with USD JPY, you get Euro JPY. And we have the exotics. The exotics usually are made up with when Euro, dollar, or GBP is crossed with the currency of a less developed economy. For example, the South African rand, the Turkish lira, the Singapore dollar. So we have GBP ZAR, we have Euro, Turkish lira, USD, Singapore dollar. So basically the movements between the three is different. The majors mainly move because of the dollar. So the dollar mainly controls the majors. And because the dollar controls the majors, and the majors are the one that makes up the crosses, it's you can say a significant move in the dollar can make a significant moves also in the crosses. So when you find in a week when the dollar is not having a significant move, then you find even the cross pairs are not good. Okay. So a pair like Euro JPY, Euro JPY may move along with Euro USD when euros maybe euros are strong, maybe euros are weak. But also it may move along with USD JPY when the yens are strong or the yens are weak. So you can see how the two correlate. So a movement in the cross pair can be affected by either of the two currencies. And you have to be quick in identify a potential move in this. But nowadays, we have Light Forex broker who has all the indices for currencies, like we have the dollar, the NZD, AUD, all of them, the LFX pairs. So you can simply look and you see GBP card is moving, so you go to the Light Forex broker and you look at the pound index. Is it the one moving? You find that pound index is it moving, so you go to the card index and you find the card index is moving. So you can simply look on all the card pairs and maybe you find a potential move and trade along with it. So basically when dollar buys, you find USD XX pairs, these like USD Swiss franc. I will also buy along with the dollar, and the Euro USD, GBP USD, and NZD AUD USD will be selling. So that will be the dollar disparity. And you need to have a reason of why a certain pair move. Why is USD card falling? Why is GBP card rising? Why is this? You need to have a reason. Is it because of the card or the pound, or is it because of both? You see, sometimes both may have the confluence for that pair to move. For example, today we had euro. Euro was strong, and JPY became strong also. So Euro JPY had a very big move also yesterday. While the pairs showed that they might have a reversal, but they decided to have a continuation to find targets in higher time frame. So if you're quick, you can identify a potential move in certain pairs with common currency, and then you can trade them. And we have times in the year where there are stop and trap moves, trap times. You can easily identify the range in markets, or we have these markets which extend further to hand stop losses. So you can easily identify this, and you know that maybe now pounds are moving to hand stops. For example, right now we have the AUDs and the NZDs hunting stop losses in our time frame. So you find further extensions. So you need to be very careful when trading those pairs until they have a potential very good reversal. Then you're good to go with the change of the trend. And fractional disparity will help you in choosing your portfolio of trading. You cannot trade every pair, and you should never pick all common pairs. See, there is no holy so losses can occur too. You don't have to. You don't need to all pairs to put you in loss. And the advantage of having a good portfolio is that you can easily grab 2 to 3 picks every week, and that's usually my target. And this is my portfolio. I've chosen the pairs which mostly move during London session. See how I move during London session, and they have different currencies. So, for example, for the Audi, I only chose Euro Audi. For NZD, I only chose Euro NZD. For JPY, Euro JPY. Pounds, I have Pound USD and Pound card, but also Pound card and USD card is for the cards. And all these are the USDs also, USD chef. See, Swiss francs pairs are usually rough.
Yeah, I noticed. I don't really like trading Swiss franc too much.
Yes, but for USD Swiss franc is somehow moving with the dollar, so it has a good move. And I have one commodity, gold, I don't trade silver, and one exotic USD ZAR. And indices, Nasdaq, S&P, which have almost the same move. So if Nasdaq is falling, you find S&P falling. And I have this volatility 75. These three, I have not traded them effectively. Okay, so we have understood how these pairs work. Now, let's go to the second part, market structure of price action. Basically, price action, when we talk of action of price, we are looking on what price has done in the past. So price has reached a certain level in the past, and there it formed a double top, and then did have a bearish move. And later on, price reached the same level. Like last year, it formed a name on that area, and this year has reached the same level. And that's present price movement. And out of the two, we make our subjective trading decision. So we analyze the market based on past and present price movement, and then we make our trading decisions from there. That's action of price. Now we need to start from the lowest level, and here we are talking of the price foundation. This is the primary price action knowledge. We need to know on the swing points, the swing highs or the short-term highs, and the swing lows or the short-term lows, or we can call them the bullish fractal and the bearish fractal. These fractals you can find when you find two lower candles on the left, two lower candles on the right, and one in the middle which is higher than this. So this will be called a swing high or a bearish fractal or a short-term high. And if you find two high candles on the left, two high on the right, and the one in the middle which is lower than this, so this is called a swing low, a short-term low, or a bullish fractal. And we notice that in higher time frame, when you wait for all 5 candles to be formed, then price will be, I would have already moved quite a number of pips, so we only wait for 3 candles. So we have broken it down to 3 candles, and 3 candles have proven to be effective. So we only look for 1 candle in the left, 1 candle in the right, and the one in the middle to form a swing high or a swing low. So basically, when the market is trending, when the market is moving up, when the market is moving down, you find them forming the swing highs and swing lows. So for a bullish market, the market will be forming swing lows. So we have a bullish market. So here is where it formed. So the market will be forming swing lows. Here we have a swing low. And then they come to retest previous swing highs. So sometimes they come to retest this, or we know that the market is having a continuation when it breaks a previous formed swing high. So the bullish move is still continuing when it breaks this. And the same for a downtrend, it will be forming swing lows and swing highs and breaking previously formed swing lows. So generally, markets trades from short-term lows to short-term high back to form a new short-term low. So as these short-term lows and short-term high forms, there is what we call a market structure of price action. And we have several structures that we formed when these short-term highs and short-term lows are formed. We have the intermediate-term lows, intermediate-term highs, long-term lows, and long-term highs. For intermediate-term lows, we have a swing low on the left. Price trades up, comes back down, breaks this, forms another swing low here, trades up again, and then forms another swing low on the right, which is higher than this one in the middle. So this is what we call an intermediate term low.
Okay.
People have named it an inverted head and shoulder pattern to make it easier. And the same for intermediate term high, you find a swing high on the left, the one in the middle which is higher, and another swing high on the right, which is lower than the one in the middle. So this whole structure is called an intermediate term high. So it doesn't matter whether the neckline is slanted or slanted like this or straight, but what it matters is that we have the swings. The one on the left and right are slightly below, and the one in the middle is slightly higher. And sometimes there is no perfect visibility in that. And we have a long-term low when you have an intermediate term low here, price trades up, and then comes back down, breaks this, and then forms an intermediate term low here again, trades up and then comes back again, forms an intermediate term low here. So this structure is called a long-term low. So for an intermediate term low, a short-term low, to go into a long-term low, we can definitely see that for a short-term low, then the swing that will be formed here will be a short-term swing. This will be somehow taking a few days, and this will take almost a month or two if you find a long-term low like this. And this, when you go to the daily time frame, you find an inverted head and shoulder. And when you go to the hour 4, you find this. Usually that occurs like that. And we have a long-term high. A long-term high is when you find a head and shoulder on the left, head and shoulder in between, and then we have a head and shoulder on the right. So this whole structure will be a long-term high. So these structures when these structures are formed, and you know that the market is trending up or the market is trending down, and you find this structure is forming, then that indicates that the trend is about to change. So we have an example here. Told you sometimes there is no perfect visibility like the one you have here. See, there's a wick here, but the body closed here, and here we had another one, and here we had another one. So this was all an intermediate term high. The same here, we have high, short-term high, and this, so this will be an intermediate term high. So this is the daily. When you go to R4, you find this one, intermediate term high, and an intermediate term high here. So this will be a long-term high. And we had one on the dollar. This one was very good long-term low. You see this one. We don't have like an inverted head and shoulder. Here we have an inverted head and shoulder, but it's not that perfect. And also here. So these three formed a long-term low, and we had a very good uptrend of the dollar. And this was January. You can go through your charts and you see the move. And this was USD CAD. So we have learned on the price foundation, and we went further to look on the structures that may be formed when this short-term high, short-term low, the swing points, when the market is trending and forming these swing points. And we have the candlestick patterns which are within these swing points, are within these intermediate term highs, or within a trending market. So these candlestick patterns can be, you need to view them in the right market context, because in the wrong market context, they have little or no meaning. Like when price is around a fib retracement level, or when price is around a support area, resistance area, or when price is around a pivot point, or around a certain area of price action, or a certain EMA. So you need to look on the candlestick patterns that are formed to know that now the market is about to reverse. And I usually don't teach the candlestick patterns because this is the basic thing that everyone should learn on his own. See, I teach the hard stuff. So can go through it at your own time. The candlestick Bible is the best, yeah, when you're
Yeah, it
talking.
is good.
And we have the chart patterns. These chart patterns usually is a combination of several candles and they form a certain chart pattern. We have the reversal patterns, which signal that the ongoing trend is about to change. And here in the reversal pattern, we have the double top, the double bottom, which are the M's and the W's. We have the head and shoulders, the intermediate term high, the intermediate term lows, and the falling and the rising wedge. So falling and rising wedge simply means that this was the initial high. Market makers came to take it out again. So these are several stoppers until the dealer has the liquidity needs and then fall. The same is this one. So it's basically the same as the harmonic patterns when you view it from the dealer's point of view. So we had one here. This was USD JPY from the initial high, came to break it, and again. And last year I formed a double top on this one and then it fall. So the rising and the falling wedge, the head and shoulder, the double top, the double bottom. Well, we usually, when you learn on the price action, we usually view them the areas of support and resistance. But when we go further to the market making, when you learn the market maker cycle, then you go to specific levels where the market might reverse. It's not simply an area of support or resistance, but you learn the dealer sentiment and why the market has reversed. So from there, you can know where to look for these reversal patterns. And we have the continuation patterns, which are those chart formation that signal that an ongoing trend will resume. The falling wedge and the rising wedge, I take them as top and low, top and high, then drop. And we have the bullish rectangle and the bearish rectangle. And this usually confusing because you know that you're very sure the cycle is not complete. The market is trending up, and the dealer is forming maybe here when the dealer is forming this bullish rectangle, the dealer will form an M first. So he has hit the high twice. So you're now confused. And then he comes again to hit the high. Hit the high. So you have to be strong on your buyers that the uptrend will continue and eventually you find the market going up. And this happens a lot on the hour one time frame. And you have these pennants. These ones are the one which, so usually if you go to the 15 minutes, you'll find them. And here is where they form the type 2, type 3 London patterns. But on the daily, when you learn of the daily structure, you find the pounds, they might have these pennants. So they show that the market will continue. I only had one flashcard on the rectangle here. So this was EURUSD, and I had this flashcard because on the time that I was teaching this, this was happening. And one of the students asked me, what is EURUSD doing? So I got the flashcard from there. So he was buying at this level. And he was afraid because the 3 times a year is not met and all that. And I was on the sale. I entered sale on Monday, yes. Okay. And it came to fall on Wednesday. So we have the bilateral chart patterns, the one that we should never be looking for in the market because You see they say these are tricky. They signal that price can move either way, but I always need to have a view in the market. Always have a view in the market. Always know where the market should move next. And your view can be correct or wrong, but you should always have a view. So if many of your views are wrong, then you are wrong somewhere.
Mm-hmm.
So we have these triangles. So you should never look for this. I definitely know that now the cycle is complete. The market is about to reverse. Maybe you have a reset and all that. High time frame is telling me this, so you should have a view. Now, let us learn on these points where the market might reverse from a price action point of view. We can define support and resistance points as the support is usually the floor, the resistance the ceiling. Support lowest point price reaches before reversing, resistance highest point price reaches before reversing. And these levels work best at high time frames. I go half hour, daily, the weekly and the monthly. I usually use them a lot on the weekly and the monthly time frame. So these areas is where retail traders look for reversal and touch again by price in the present time. An area of support becomes valid when it is touched twice. So when price comes for the first touch, this is not an area of support. But when it comes for the second, this is now an area of support. And the same for resistance. And we can categorize the support and resistance points as natural, implied, and the classical. The natural ones are simply the previous highs and lows, and we can talk of previous yearly highs, monthly, weekly, daily highs or lows, even the session highs or lows. Because sometimes you may find yesterday the market makers formed the high on the New York. See, this was the session high, and they ended up the day with consolidation. The next day, we find the stop point is around this previous day New York high, and then the market falls. So these are also natural support areas or natural resistance areas. And we have the implied ones. The implied support or resistance areas are the ones that speculators look for as areas of interest. So when speculators look at fib retracement level, maybe the equilibrium point, the 50% level, and they view as an area of interest where the market will reverse after retracement and it will continue with the previous trend. Then, when speculators enter orders at that specific position, and here we are talking of large speculators, then eventually the market would move in that direction. So it's an implication of the view on the price moved because of the view of the large speculators. Like they had a view that at that specific level price would go up. So they have their orders there, demand and supply, eventually the market would move. So we have the fib levels and the pivot points. And we have the classical resistance, support and resistance points, which are the order blocks. And in the order blocks, we are talking of specific price levels here, not a zone like the natural and support and resistance. So this is I marked the highs and lows of the month, the monthly highs and lows. This was GBP USD last year. So these were highs and lows of the month, and you can see as price coming to retest these areas and then continue with the trend. And you can clearly see that when price touch the first time, on the second time, usually price breaks the initial high because up here lies liquidity. So buy stops are usually willing buyers at this position. So when market makers enter their sales at this position, they find liquidity, they find willing buyers. So eventually their orders are entered and price will reverse. And we had another retest here. We had a break. So this was the low of 2016, and price came to bounce, and the second leg was used for a stop hunt, and then eventually the market reversed. This is USDR, and this is GBP/USD weekly time frame. So a larger view show the low of 2016. And let's talk of the implied support and resistance points. We have the Fibonacci. The Fibonacci, it was derived from this Fibonacci series. This was all mathematics. But our Fib levels that we're interested in are these ones. The zero level, 62%, 70.5, the equilibrium. The second leg stop loss level, we have. So I hope you can add this on your Fibonacci tool. I hope you know how to add them. So Fibonacci tool works best when the market is trending. The idea here is to go long or buy on a retracement at a Fibonacci support level when the market is trending up, or to go short or sell on a retracement at a Fib resistance level when the market is trending down. So before you plot these Fib retracements, you need to first identify the recent swing highs and the recent swing lows. You should note that not always price would react to these levels. So they should be looked at as areas of interest. And here we are going to talk of the equilibrium markets, the premium, and the discount markets. The equilibrium markets, the equilibrium level is usually the halfway point from one swing point to the next. So it's the 50% level, like, see, the market consolidates and then trends up. So we have the swing points on the consolidation. See, I usually use the equilibrium points when the market consolidates, so around the peaks. And I usually look for the swing and then the swing lows that are within this range. So I put my Fibonacci tool from here to here. So the market has consolidated. I've put my Fibonacci tool there. I expect the second leg here to come to 79% or 88% level. And 88% level is the one that we have described as the second leg. And then eventually a new expansion is formed. See, when the market is consolidating, see from this point to this point here, the market was consolidating, meaning that orders were accumulating on both sides. We're talking of the pending orders or the stop orders. When I say the stop orders, I talk of the one that have entered sales and put their stop losses here, buys and put their stop losses here. So orders are building on both sides. Market makers are allowing this. And eventually, market makers would go and fetch the liquidity and a new expansion will be seen. So I expect the second leg to be around 88% level. And after the market has expanded, we expect the impulse swing retracement should come all the way to 50%, the equilibrium level, and then move away from it. So the equilibrium level will be the halfway of this consolidation range. So I expect price to come and retest the halfway point of this consolidation range. So the impulse swing and price away from the equilibrium price level, that is found exactly in the halfway point of the consolidation range. So we should expect
88% first.
Yes, 88% is the one that would give us the second leg.
Mm-hmm.
And after giving us the second leg, then we should expect a new expansion. After expansion, then we should have our first retracement. So that will be like a level one consolidation. So stop and flow rise. And that would give us an entry on the equilibrium point. So we had here, so you can see this range. We had a range here. So I usually look for equal lows like this.
Mm-hmm.
So when the market forms perfect equal lows like this, I am very sure they will come down to fetch the pending orders and the stop losses. After that, I wait for this impulse swing. Usually this, I wait for this swing. Usually this swing breaks this high to fetch the orders up here. And then you can put your Fibonacci, wait for price to come to the second leg. That will be your area of interest. You go to the 15 minutes, wait for the pattern. And when you enter your orders here, your stop loss is at this price.
Okay.
And then your first target should be the first TP here. And you should expect for this coming back to the equilibrium. And here we had another one. See how the dealer came to take out these lows. So he came to take out these lows, came again to take out these highs. So there you can plot your fib. And then the market eventually came to the second leg, gave us the pattern, then moved away from it.
Do you always draw this on the H1 or the 15-minute?
The Fibonacci and the H1.
Okay.
And sometimes I draw it on the daily.
Okay.
Okay, this is also, now let's talk of the discount markets. Now, suppose the market is trending up. We have a bullish market structure. And an impulse swing, you expect for an impulse swing coming to the equilibrium point, and then from that point, you expect the market to form a pattern there and then move, continue with the bullish trend. And the impulse swing now move below 50% level. Anything below the equilibrium, anything down the equilibrium is the discount market. And the discount market, 62% is the minimum level. Like here we have the 62% as the minimum level. And what I have noticed is that when price has moved quite a number of pips, like this is the hour 4 time frame.
Okay.
This is a very great number of pips. Then the retracement, if it decides to retrace, eventually to break the equilibrium. And when the prices had moved further, then this retracement would break to sweet spot optimum trade entry.
Okay.
Yeah. So you should also consider that. And we have the premium. The premium market is when the market is trending down, and you expect that a retracement will go the way to the equilibrium, but then it breaks the equilibrium, goes further above it with a maximum of 62%. Then that's a premium market. And always allow price to break it when you see that it has moved quite a number of pips. And we have the optimum trade entry. So when the market retraces, see after a big swing like this is how this was a complete cycle in the hour one. We had 3 good levels here. And we had now a retracement. See, it came all the way to the sweet spot or T. And when you learn of the blocks, this is the mitigation block here. So usually mitigation blocks are this the price reverse around the sweet spot, the 70.5% level. That is all about the Fibonacci. Now let's talk of the pivot points. The pivots are calculated based on the daily candle. So yesterday's price action gives you today pivot points. So every day you find the pivot point positions will change. M1 position for yesterday is different from today. And you can, if you are a black and white trader, then when a red candle is closed today, then you should expect for tomorrow price to move M1 going M3 or M3 going M1. If the candle has closed green, then tomorrow you should expect M2, M4 day. So either from M2 to M4 or M4 to M2. But you need to be a great trader. Like, you need to know which levels to be looking for sells, which levels to be looking for buys. So we have the oversold and overbought levels.
Okay.
And suppose now you know that yesterday the market formed a peak. We had clear 3 levels, clear 3 intraday levels. The day ended off with consolidation. And this was Asian. So this is M2. M2 going up is our overbought area. So any area where price would form a stop and high and then a pattern should be a good area for sale because it's an area for overbought. And for a bullish trend like this one, this is Asian session, Asian close. So we have, this is M3 going down. This is the oversold. Going up, this is the overbought. So any pattern forming around this pivot, this M2, going down to S1, and if it goes further to M1, that's a high risk trade. But if it goes to S1 or M2, this M2 gives you a high probability setup. S1 gives you also a high probability setup, but when it goes further to M1, that's a high risk trade. And suppose now you have missed an entry and price has already reached this red zone, then you should never look for buys because it's an area for overbought. So the same to this one, when price reaches M3 or R1, so any price level around this range would give you will give you a pattern, and that will be high probability setup. But when it goes further up, then that will be a high risk sell. And suppose you have missed an entry and price reached this this level here. That's an area for oversold. I should never look for sales there. You'll be chasing price. So that's how I use the pivot point. So I do not rely on only M2 to M4 or M1 to M3. I usually look for a range.
Okay.
So that's all about the implied support and resistance points. Now let's talk of the classical support and resistance points. Here we're talking of order blocks. Order blocks gives you specific price levels where market might reverse, and not a range. So order blocks are specific candles or bars that, when properly viewed in institutional context, can highlight smart money buying and selling. So you can find where smart money has entered their sales or has entered their buys. And let's have an example here. So we know that from down here, the smart money buys. Any retracement you see, like this red candle here, it means that smart monies have sold. That means they are closing their buys, and then eventually they are opening new buys. So when they reach this area, this last candle here, which has the most body from the open and close, this candle indicates that before the market reverse, this candle indicates that smart money were closing their orders and opening new orders for a reversal. So at this level is where smart money entered their orders. So we should expect that when price trade through it, once price reverse, this becomes a valid order block. So we usually wait for the market to return to this order block and then give us a retest around this area and then continue for a downtrend. So this is called a bearish order block because it indicates a start of the bearish trend. And the same, this is called a bullish order block. This one is a bullish order block, the same as this one. So you look for a candle that has the most body. Sometimes we can have two candles that can form a whole block. We'll look at it later on. We have it on the this one on gold. So we have, see these two candles here going down. We had this long candle here, which has the most body going down, but these ones are the ones that are close to this area here. And the second candle just feel the wick. See, the second candle just feel this wick. So this whole candle becomes a block, and this is a bullish order block. So price trades through it and then comes back for a retest, and then so sometimes this area becomes a support area, like what you can see here, and then price moves away from it. And this has been seen also in Euro USD before it moved up. I think it had this, and this was bearish order block. See this area of resistance here. This is USD ZAR. We had a bullish order block here, and then price came to retest it several times and went up. So we usually wait for the retest and enter our orders in the 15 minutes, the same entries that entry criteria that we use on the M's and W's will be used here. So the M's and W's are the same on the 15 minutes. And the stop loss should be when you enter your cells and you have your order block here, the stop loss should be above this order block. And then when price has moved further, you move your stop loss at a 50% level of the OB total range. So this will be a good location to minimize your risk when price has moved further away from the order block. And we have the mitigation block. The mitigation block usually occurs when price has reached an area of resistance, has formed the initial high, and we have a bearish trend there. It forms a swing low here. We have a bullish. It did not come to take out the initial high that has been formed, or it has not formed equal highs, and then the market eventually reverses. Comes to trade through these swing lows, this previous form swing low. Then this becomes a bearish mitigation block. So this last red candle here, this last red candle which formed this swing low here prior to this, and then that becomes a mitigation block, a bearish mitigation block. And we have a bullish mitigation block, which is the opposite. So here we have the initial low, and then price did trade away from it. And here we have the last green candle here, which formed the swing high. And price eventually comes to take out the swing high. So this becomes this last green candle becomes a bullish mitigation block. We usually wait for price to come back to retest this. At this area, we call it a seller's remorse because we have sellers who entered sales here. So they're in the wrong position, they're in loss. So they're given a chance to take out their trades and continue with the trend. And we have what we call the, this is an example here. This is another example. We had our mitigation block here. We have the breaker blocks. On the breaker blocks now, they are similar to mitigation, but the initial high or the initial low that is formed will be taken out. So the last swing prior to this breaker, here we take the last red candle here, which formed this last swing low prior to this breaker. Then this becomes a breaker block. And from this flashcard that I've drew, you find that there is another swing high here, but it's not necessary for this to be formed. Sometimes you may find it and then price eventually comes to trade this position. Okay. So that's a bearish breaker, and this is a bullish breaker. So you have an example here. You see this is a breaker block here, and then eventually price came to retest it. See, at this point here we have, see, there was a swing low here and another swing low here. So this was the last swing low prior to the breaker. So we take this block here as the breaker block. Okay.
Okay.
And we have what we call the last step broken. The last step broken is usually the same as the mitigation and the breaker block. Because at this point, we had this this last red candle here. So this was a bullish order block. So we expected price to come and retest this and continue with an uptrend. But then price breaks through it. And then later on, it came to retest this order block. So the whole process is called a last step broken. So when you go to, this was clean highs here. I usually use the last step broken to trade on the 15 minutes. Like we had this red candle as the bullish order block, price straight through it. We expected price to come and retest and go at this level, but then it did break it. And then later on, it came for a retest at this point. So this is called the last step broken. So suppose this high was not taken here, then that will be a mitigation block. Suppose this initial high was taken out, then that will be a breaker block. So LSB is the same as the mitigation and the breaker block. And we have the propulsion blocks. Propulsion blocks occurs when these OBs are retested. Like we had, this was a bullish order block. Price trade through it, came for a retest halfway. And then price trade through. We had another one here. Price come for a retest again. So this becomes a propulsion block. So when price comes to retest this again, then that's where you take your entry. And usually these are the zero drawdown trades.
Oh, okay.
We had one today on gold.
Yeah, I saw gold had a nice sell today.
Yes. We had one today on gold. So this was another example here. And we have the vacuum blocks. Vacuum blocks is a gap created in price action as a result of a volatility event. So the gap forms a vacuum of liquidity. So no orders were entered at that vacuum. So market open on Monday can create a gap, a session open can create a gap. So we have a gap there. So orders were not entered here. So we can call it a vacuum block, but it's also a fair value gap. Like there is no fair value prices around this area. So market makers will have to reprice to these levels to fill in the areas where they have not traded for fair value. So when this gap is filled, this now becomes a block. So this order block, we should expect that when price trade through it, should come for a retest, okay? And sometimes you find the market filling the gap and then moving away from it. So when it
Yeah.
fills, this this candle here becomes an order block. So when you wait for a retest on that, then that's an order block. And see, one student had told me on where is USD card here? So on the daily, when you look at USD card, we have a gap here that has to be filled. I expected the market to come and retest this and come to fill the gap and then move. But for us to see, the market may just fill in the gap and then reverse from there. So this would become a block here. So we'd have a block there. And the same we have on Euro USD. We have a block here that has been filled. So I'm expecting price to come to this level. And this is where 3 times ADR will be met. We have the blueberry there and form a reversal pattern from there.
Okay.
On the monthly, when you look at Euro USD, see there was another block here. This last red candle here. See several retests on this, and then eventually the market moved. So that was an area of interest there.
You can find those order blocks on all time frames.
I usually find the order blocks based on the hour, daily, or the weekly.
Okay.
So let's talk of the market structure. Now we have talked of several structures, several formations, and we know that if these formations come to play, then we can have a market structure of price action. And markets usually starts a long-term move on areas of support or resistance. And here we are talking of an area where the dealer has formed equal lows or equal highs. And they work based on monthly, weekly time frame. So around these areas, we can also find intermediate term highs or intermediate term lows, or long-term highs or long-term lows. So when you find the dealer forming these double top, double bottoms around these areas of reversal, or these intermediate term highs, intermediate term lows, long-term high, long-term lows, then you should know that the market structure has changed from bearish to bullish or bullish to bearish. So the bearish market structure will only be broken when the price forms intermediate term lows, long-term lows on an area of support. Then we know the bearish structure is now broken. We expect for bullish market structure. So when you are analyzing these charts, you should identify areas with equal highs or equal lows in our time frame. So look and note for these clean highs and lows. Then you'll identify the current market structure and trade around with it. I usually draw these clean highs and lows even on the 15 minutes time frame as the market is moving. Because they help me in identifying the buy side liquidity and the sell side liquidity. And we talk of that tomorrow. So here we have an example of Euro USD. So we had equal lows here. And here is where the market started its move going up. And then when it reached this point, we had equal highs. You see, they're not that clean as this one. And then we had a bearish structure, came to retest at the blueberry here. And this was also, there's a swing point here. So this was a retest. And then this bearish market structure was now broken. So BMS is the break of market structure here. And the market is now bullish. And they came again to form equal lows. At this point, the market became bullish. And here we had a break. Here we had equal highs now. Now we know that the market structure has now formed, has now transformed to bearish. We had equal lows, equal highs. So when you are doing your analysis, you need to identify this. Like right now, we have equal lows on Euro USD, right? We have a W on the monthly. And this is Euro Pound on the monthly, and we have Euro Pound on the weekly. So when you go from monthly to weekly, monthly will give you a market structure for position traders. So you have a long-term view. But when you come to the weekly, then you can have a short-term view. So it's good for swings when you come to the weekly time frame. And you know that when market structure is broken, the next target should be the next support or resistance point. And here we are talking of all types of support and resistance, the natural, the implied, and the classical. And quarter numbers can help you identify these potential targets in our time frame. Weekly market structure can give us a good market flow for the daily and the hour time frame. It is good for swing trading. And let's now talk of the market flow now. Suppose you have a bearish market structure, like the one we had on Euro USD. Then we come to the daily, which is the same as the hour. You see the daily and the hour are simply the same. And you will see a short-term bullish market flow and a long-term bearish market flow. When a bearish market flow is, see from this point here, you can find that these swing highs that were formed were not taken out, except for this one. See, we're not taken out, but all the swing lows that were formed, all these short-term lows that were formed, were taken out by price. When price reversed to go short. So you should expect that you have a short-term bullish, a long-term bearish, short-term bullish, a long-term bearish, short-term bullish, a long-term bearish. The bearish should take out the lows when you have a bearish market structure on the higher time frame, okay? Weekly and monthly. You need to be comfortable with less than perfect visibility. That is what I mean when I say avoid overcomplicating. Like when you are selecting your direction bias, you need to be comfortable with less than perfect visibility, because I see the market is not black and white. You can have bullish market structure, you have done your analysis and you see on the hour one the market structure is bullish, and then the next day the market makers breaks it. See, you're not 100% sure that the market makers would play along with your analysis. The price will sometimes play along, sometimes not play along. So there's no perfect scenario, not expect 100%. So that's all I have for today. Tomorrow meet again to learn on the buy side and sell side liquidity.
Okay.
Thank you for listening.
Same time tomorrow?
Yes. Same time.
Okay. Thank you so much for everything today, man.
Okay. If there will be any changes, I'll tell you.
Okay.
Okay, thank you.
All right, thank you.